Welcome to vTalkInsight, Market Drivers Daily for December 25th, 2025. Markets are closing out the year with record highs, powerful AI-driven growth narratives, and some of the richest valuations of this cycle. Today we look at how resilient demand, the AI build-out, and stretch pricing are interacting across macro data and markets, and what that balance could mean for risk-taking as we move into the new year. Growth momentum is still leaning to the upside, even after an impressive run of data in recent weeks. In the United States, third-quarter GDP growth significantly beat expectations and was the fastest expansion in 2 years, reinforcing the reacceleration theme we have been tracking. Consumer spending is growing around 4 to 4.5% year-over-year in the fourth quarter, and that combination of solid activity and resilient demand is underpinning both earnings expectations and risk appetite. The consumption story is showing up very clearly in holiday behavior. November spending was up roughly 4% versus a year ago, and holiday retail sales are projected to grow at least 4%, with some forecasts closer to 4.5% or even 5%. Road travel is expected to hit a record, with well over 100 million Americans driving, helped by gasoline prices around $2.85 a gallon compared with just over $3 last year, while air travel is also set for new highs. Together, that points to a consumer still willing to spend on both goods and, increasingly, on experiences. Beneath the headline numbers, spending patterns continue to evolve. Households are trading down on some items and becoming more price-sensitive. Yet restaurant sales are still trending higher, and experiential retail locations saw Black Friday foot traffic rise by close to 10%. There's a clear shift from goods towards services, travel, and wellness, and that tilt toward experiences is likely to persist into the new year, supporting service sector revenues, even if goods demand normalizes. On the corporate side, investment is increasingly a growth engine in its own right. Business spending led by artificial intelligence is expected to help lift U.S. GDP growth from around 2% to roughly 2.4% next year, and policy incentives are encouraging capex to broaden beyond pure technology into manufacturing and infrastructure. Japan has agreed to accelerate about $550 billion of investment projects in the U.S., while China is deploying targeted housing and currency measures to stay on its growth path, and analysts see corporate mergers and acquisitions picking up meaningfully into 2026. In parallel, new growth franchises from obesity treatments to vaccines, tokenized assets, and even niche areas like padel and global sports leagues all signal that opportunity is not confined to a handful of tech names. Financial markets are responding to this backdrop with a clear pro-cyclical tone. Equity indices remain in a strong uptrend, supported by upward revisions to earnings and GDP estimates, and sectors such as banks, transports, and industrial commodities are showing renewed leadership. Bank of America expects the Federal Reserve to have room to cut rates in the first half of next year as inflation trends toward target, which could support small and mid-sized business activity and reinforce the growth impulse. In Europe, a stronger outlook helped by German fiscal spending is expected to reduce default risk in high-yield credit and support further spread tightening. There are, however, important caveats to this upbeat picture. Recent U.S. growth around 4.3% has been flattered by temporary factors such as net exports, and GDP has been heavily concentrated in AI investment and high-income consumption, leaving the cycle vulnerable if either slows. Consumer confidence has softened even as jobless claims drift lower, and the Federal Reserve still projects growth of around 2.3% next year, which is above trend and raises questions about how far it can ease without reigniting inflation. Investors will be watching how actual holiday sales compare with the optimistic forecasts, whether consumer spending can stay near 4% growth once tax refund support and lower gasoline prices fade, and whether business investment truly broadens beyond AI. That leads us naturally to the second major driver of this expansion, the AI cycle itself. Artificial intelligence has moved from a niche theme to the center of both the economic and market narrative. In recent days, we have highlighted how AI-related capital spending has become a key contributor to U.S. GDP, with infrastructure build-outs for data centers and chips feeding directly into headline growth. Both major political parties in the U.S. now treat AI as central to economic, industrial, and national security policy, reinforcing the likelihood of sustained support for the sector. On the ground, corporate adoption is broadening well beyond the large U.S. tech platforms. Banks such as Standard Chartered are embedding AI across operations, from productivity tools to fraud detection, compliance, and wealth advisory, aiming to gain both efficiency and competitive edge. Retailers are using AI to optimize inventory, improve pricing and promotions, and enhance customer experience, while the restaurant industry is deploying automation to offset higher labor and input costs. Even after staff reductions, some service sector firms are reporting faster project turnaround thanks to AI and data integration, pointing to early but tangible productivity gains. AI is also influencing sector leadership and corporate strategy. NVIDIA and AMD remain at the heart of the infrastructure build-out, and a software automation company recently surged after being added to the S&P Midcap 400 on expectations it will benefit from AI demand. ServiceNow's acquisition of Armis, a fast-growing cybersecurity firm, underscores a push into AI-driven security automation as cyber risks escalate. In healthcare, expectations that AI will accelerate drug discovery and improve operational efficiency are one reason many see the sector as a potential outperformer into 2026. The AI cycle is tightly linked to real economy demand for commodities and infrastructure. Copper prices have jumped above $12,000 per ton, driven by data center construction, clean energy projects, U.S. stockpiling amid tariff uncertainty, and supply disruptions in key producing countries. Industrial and precious metals such as gold, silver, and platinum have also posted outsized gains this year, reflecting a mix of safe haven demand and structural investment in AI infrastructure and global green energy. Looking ahead, AI-related capex is expected to be a major driver of business investment, with some forecasts pointing to a notable acceleration in U.S. GDP growth next year as spending ramps further. Alongside the optimism, risks around AI are becoming more pronounced. There are rising concerns about increased debt financing in AI-related companies, including a reported $120 billion of AI infrastructure debt being moved off balance sheet into special-purpose vehicles, which could obscure risk if demand underperforms. Some observers liken aspects of the current boom to the late 1990s, with speculative funding, ambitious capacity build-outs, and valuations that embed very high expectations for future cash flows and productivity. AI's direct contribution to GDP has already faded in recent quarters, and aggregate productivity gains are not yet evident in the supply-side data, raising the possibility that markets may be extrapolating benefits too far, too fast. This tension between transformative potential and execution risk is likely to define the AI theme from here. Equity markets are currently enjoying a low volatility, momentum-driven rally into year-end, with AI still a key performance driver. But analysts expect a shift in 2026 toward demanding clearer returns on capital rather than just headline spending. In that environment, leadership could broaden from mega-cap platforms into sectors such as healthcare and industrials that harness AI for tangible productivity gains, while weaker or over-leveraged players face greater scrutiny. Key watch points include hyperscaler capex guidance, evidence of sustained productivity in company results, the behavior of AI-linked credit spreads as off-balance sheet financing grows, and how competition from China shapes pricing power. Those dynamics feed directly into our final theme, the question of how much optimism is already embedded in today's valuations. Across public and private markets, valuations are now at the upper end of historical experience. U.S. equities are trading at forward price to earnings ratios in the mid-20s, compared with a 10-year average closer to 19, and the top 20 S&P 500 companies are around 40 times trailing earnings and about 28 times forward earnings. Overall, equity and private asset valuations, including crypto, are at record highs relative to GDP, and consensus forecasts for more gains after several strong years leave little margin for disappointment. Market gains are also highly concentrated. A narrow group of mega-cap and AI-linked stocks has driven much of the index-level performance, while many other blue-chip names, especially in sectors such as pharmaceuticals and consumer staples, trade on depressed multiples and offer relatively attractive dividend yields. Financial stocks have re-rated after a strong run, but still sit on low teens earnings multiples versus the broader market's mid-20s, and there are perceived undervalued opportunities outside the crowded trades. Rotation into European and UK equities is partly a response to stretched US valuations and momentum, though questions about inflation and the timing of rate cuts make the durability of that shift uncertain. Market behavior is adding to valuation anxiety. Equities are at or near record highs during the holiday period, but trading volumes are very low, suggesting the latest leg of the rally may lack strong conviction. Volatility measures such as the VIX have drifted lower, signaling a degree of complacency even as valuations and expectations climb. And recent technical work points to limited upside from here, with measured move targets for the S&P indicating that risk-reward is no longer compelling. Together, rich pricing and subdued volatility increase the risk that an external shock or an AI-related disappointment could trigger a more pronounced correction. These valuation dynamics are not confined to equities. Credit spreads have tightened alongside the stronger growth outlook, and a better European backdrop supported by German fiscal expansion is expected to further reduce default risk and high yield, but that also means less compensation for taking credit risk. At the same time, heavy upcoming supply of long-duration investment-grade bonds from AI infrastructure providers, particularly in euros, is likely to pressure existing long-end valuations and force a repricing across the duration spectrum. If the Federal Reserve cuts rates into still strong data, history suggests long-term Treasury yields could actually rise, complicating efforts to benefit from both lower policy rates and higher growth. Looking ahead to early next year, several signals point toward a more range-bound, volatile phase rather than a straight extension of the recent rally. Despite strong GDP data and solid earnings forecasts for 2026, markets are expected to consolidate in the first quarter as investors digest gains and weigh valuation and inflation risks. Some strategists still expect equities to make new highs over time, supported by resilient consumer spending and economic momentum, but with higher volatility and greater dispersion across sectors. Earnings growth in 2026 is projected to be in the low teens, and leadership may rotate away from the expensive megacaps toward undervalued areas such as select healthcare, financials, and non-AI blue chips. The key for investors is how and where the rich valuations are resolved. One path is via continued earnings delivery and productivity, particularly from AI adoption, which would allow multiples to compress gently even as indices grind higher. The alternative is a sharper reset driven by earnings disappointments, higher long-end yields, or a reassessment of AI capex and leverage, which would test the more crowded trades and potentially reward regions and sectors that have lagged. From here, markets will be watching volatility indicators, sector and regional rotation patterns, the interaction between small-cap performance and rate cut expectations, and signs of profit taking in AI leaders as the new year liquidity calendar gets underway. Those signals will help determine whether the current cycle can extend with manageable bumps or whether today's stretch valuations become a more binding constraint. To wrap up, growth data and holiday spending point to a still resilient expansion, with consumers, business investment, and targeted fiscal support all contributing to better-than-trend momentum. AI remains the central engine of that story, driving capex, sector leadership, and even commodity demand, but rising leverage and questions about realized productivity make selectivity and balance increasingly important as the cycle matures. At the same time, equity and credit valuations sit at demanding levels, especially in mega-cap AI names, leaving markets more sensitive to shocks and increasing the odds of a range-bound, more volatile phase even if the fundamental backdrop stays constructive. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.